Okay, let's return to what we saw on Friday with global stocks finishing the week positively boosted by the latest round of stimulus measures in China, while gold hit another record high. And there were more records on Wall Street, with the Dow and S&P 500 finishing at all-time highs as the market was buoyed by earnings results. All three majors notching their sixth straight weekly gain, the Nasdaq up 0.8%, the S&P 500 0.9%, and the Dow 1%. Shares of Netflix surged to a record closing high after the streaming giant topped analyst estimates for subscriber additions. Tech stocks were broadly higher, including the Mag 7, Apple gaining on data showing a sharp increase in new iPhone sales in China, while Nvidia rose on analyst upgrade. American Express shares fell after the credit card company's quarterly revenue missed estimates. Procter & Gamble reported a surprise drop in quarterly sales. And energy was the only sector that dropped, led by a fall in Schlumberger after it posted earnings below expectations. Well, Atlanta Fed President Raphael Bostic has said he wants to be patient on cutting rates, saying, "I'm not in a rush to get to neutral. We must get inflation back to our 2% target, and I don't want to get us to a place where inflation stalls out because we haven't been restrictive for long enough, so I'm going to be patient." In economic data, US home building surged in September, increasing 2.7% to a seasonally adjusted annual rate of just over 1 million homes last month. And US Treasury yields fell, the 10-year down to 4.07% and the 2-year down to 3.95%. And in UK, retail sales in September rose 0.3%, taking an annual rate to 3.9%, which was above forecasts. And the US dollar fell after 5 straight days of gains as risk appetite increased following another round of stimulus measures from China that bolstered global equities. The Aussie trading at 67.1 US cents. Taking a look at commodities, oil futures fell after data showed China economic growth slowed. Brent crude futures down around 2% to $73 a barrel. Copper's up 0.5%. Iron ore around $105 US a tonne. And gold has risen 1% to another record, taking the spot price above $2,700. And Bitcoin continuing its recent rally on the prospect of Donald Trump winning the presidential election, with his policy seen as supportive of cryptocurrencies. Bitcoin approaching, well, just over 69,000 US dollars. All right, well, to get across, particularly what we're seeing on Wall Street at the moment, doesn't appear as that much is standing in the way of that momentum we're seeing. I caught up earlier with Kyle Rotto from Capital.com, who also took a look at the technicals there, which show perhaps that it is looking a little oversold at this point.
Wall Street's the big one. Sort of defying, I guess, a little bit of a wall of worry going into some fairly critical earnings this week. Obviously we've seen some data which has kind of assuaged fears about some of the economic fundamentals in the United States, but also dialed back the expectations for US interest rate cuts. And then we still have an election under 3 weeks away now, which would typically see the market sell off, but it would appear that now that's a bit of a tailwind too, because we have this kind of Trump trade coming through. That combined with a bit of geopolitical risk might be why gold's at record highs. So it's really quite positive. I mean, the ASX 200 sort of following that lead from Wall Street to an extent and sort of hanging on to some of those gains that were achieved, with this kind of hysteria around Chinese stimulus, which has obviously cooled in the last couple of weeks as the details have been made known. But, nevertheless, as it's a cliche to say, a stock market at record highs is only bullish. And that's sort of how we start the week, really.
Well, let's drill down a little further then. Taking a look at the S&P 500, Carl, what are those technicals telling us at the moment?
Yeah, well, I mean, effectively, you've got my a bit of chart art here. Like I said before, record highs, it's always constructive. It's always a bullish signal. There's no two ways about it. From a tactical perspective, I mean, going into this week and then into the US election, there's just kind of questions as to whether the market's getting a little bit of ahead of itself at these levels, and whether the risk reward as a trader is kind of there going sort of long at these levels, or whether you should be sort of waiting to buy the dip. That's effectively to say that what led the market higher at the back end of last week was the Nasdaq was outperforming the major indices, the tech stocks. That means we're pretty much driving the S&P 500 higher. And we're coming into some of these earnings now where the reporting period is expected to be propped up. The modest earnings growth actually that is expected from the S&P 500 is expected to be propped up by some of these tech companies delivering earnings around 15% for the IT sector, the communication services industry, which is obviously very tech loaded as well, in double-digit earnings growth, and that's supposed to keep earnings in basically positive territory. You overlay that, of course, too, that typically we'd see a little bit more volatility. The VIX is actually dropping at the moment, going into the election in a couple of weeks' time. So the technicals are constructive in the long term, without a doubt. It's just a point to illustrate that with markets so positive and bullish right now, momentum clearly to the upside, maybe technically overbought a little bit. If you do look at the weekly charts, we could be a little bit sensitive to disappointments this week. That's where we'll be looking at some of those earnings results, and then of course as the kind of heat starts to really come into this US election as the next fortnight unfolds.
Kyle, you mentioned gold. Everything moving in the right direction for the precious metal at the moment. The US dollar having come off along with those bond yields, but also it is that geopolitical risk.
Yeah, exactly. And those are the two stories that are effectively driving it. I think the other element is that it's a Trump trade as well. And that is to say that if you really listen to the kind of commentary at the moment, and also, the analysts that they're referring to, the economists that they're referring to, is that, the Trump fiscal proposals will add, significantly to the US deficit. I think somewhere in the realm of $7.5 trillion over the next 5 to 10 years. Don't quote me on that, but just to give you a sort of an impression of the scale of deficit spending that might come under a Trump administration, that's looking increasingly likely. Of course, if you look at betting markets, and certainly the polls as well, is that the markets are just basically following this trend towards Trump, this reemergence of the Trump trade, and that Trump trade is very much predicated on deficit spending. Gold tends to thrive in environments where there's big, deep deficit spending. And then on top of that too, you still have the markets pricing in these rate cuts from the Fed next year, albeit being priced out over the last couple of weeks because of strong US economic growth, a bit of a pullback in the US dollar in an otherwise very strong move over the last few weeks as well. On Friday was kind of what helped propel gold to the sort of above 2,700 level per ounce, above 2,700 dollar per ounce level that we saw to close out the week. And then sprinkle on top of that too this ongoing geopolitical risk as we continue to await the retaliation by Israel for that Iranian missile attack at the start of the month. Obviously, things became even more fraught over the last few days with that kind of, probably near miss, you could potentially say, on Prime Minister Netanyahu from a fairly targeted Iranian strike. So those are the factors pushing on gold, more or less. But it is, a part of this kind of rally and everything that we're kind of seeing, at least in many markets, and certainly a very strong uptrend there too to start the week.
Aside though from oil, Kyle, in fact, it has continued to come off. In fact, last week it was down about 7% on those global growth concerns.
Yeah, and it's had probably a bit of an avalanche of bad news over the last couple of weeks, just mostly on the demand side. Of course, the geopolitical risk element is there. Arguably, it's always hard to tell how traders are sort of weighing these up on both sides of the equation. But arguably, the oil price could be telling us that the risk, the geopolitical risk in the Middle East, is a little bit diminished, or if nothing else, and this is being backed up by the rhetoric as well, is that an Israeli strike on Iranian energy infrastructure, or perhaps nuclear facilities, that would mark a significant escalation and obviously disrupt global supply, is being sort of taken out of the market. That risk premium is diminishing. The other thing that we're seeing in the oil market too is also an expression of that disappointment about some of the Chinese stimulus, especially fiscal stimulus that was announced last week or last weekend. And then finally too, the kind of big knock for the oil price towards the back end of last week was both the IEA and OPEC downgrading forecasts for demand going forward as well. So really became a demand side story, as well as that risk premium being priced out. And now we've got, crude prices back below $70 per barrel after, like you said, a fairly significant swoon throughout last week.
Kyle, China, obviously you've had a raft of stimulatory measures. Today, expectations that the PBOC could cut both the 1 and 5 year loan prime rates.
Yeah, and I mean, the 5 years is the one that often is felt to be reasonably significant because it's where Chinese financial institutions price mortgages off. there is, clearly amidst this big package of measures, attempts by authorities to take pressure off existing mortgage holders, maybe not so much stimulate activity in the housing market again to try and create new loan growth, but certainly to try and take some of that financial stress off of households. In the bigger picture, though, we're still kind of seeing on the whole, really kind of constructive signals from authorities that they want to do more to maybe push the economy a little harder. The data that we got on Friday too, it has to be said, was a bit better than expected, raising hopes that maybe that about 5% growth target might still be in reach. But overall, the scale of the measures have been a little bit disappointing. Again, clearly at the last weekend, but the weekend prior, that kind of fiscal stimulus announcement was good, but certainly didn't reach that high bar that the markets were sort of expecting regarding kind of the fiscal side of things. And on the monetary side of things, well, things have been very supportive. Some of the facilities that we've also seen set up by the PBOC, the details were announced in the last few days, especially those kind of policies to allow certain financial institutions to tap the PBOC for liquidity to be able to buy equities. Good for asset markets, good for the ring fencing of financial stability risks, but still not the kind of big bazooka stimulus that might have justified that kind of 30% rally that we had seen going into Golden Week, and is now being pared back on the details of the stimulus plan. So the cuts to the loan prime rates, just another measure here to try and obviously lower some of these key lending rates in China's economy, in line with cuts to some other fairly significant rates too for China's financial system. But we'll continue to be just waiting for some of those details about policies, because again, objectively, in an absolute sense, great compared to where we were, about a month ago, and where the economy was heading. But in terms of relative to where the expectations were 3 or 4 weeks ago, a little disappointing. So it should be another interesting one, and perhaps volatile one for not only Chinese markets this week, but of course the material sector and other China-sensitive sectors of the ASX.
Kyle Ryder from Capital.com. All right, let's just check where we're likely to begin. Looks like a positive start to the week. As you can see, SPI futures up more than 0.5%. Stay with us because the open is just a minute away.